Okay, great. Hey, WFG 1031 is here, and let's kick this baby off.
Wonderful. Well, thank you for having me here today. We'll give you some basic overview of 1031 exchange, and we can go into some deeper dive if we need to. On the screen, you see the statute, section 1031. I'm not going to read it, but here's what's important. Section 1031 applies only to real estate, not to any other assets, and only to a specific subset of real estate, and that's business or investment real estate. It never applies to an investor's primary residence or their second home. The property must be property that was held primarily for use as either business or investment property. It's also important to remember that Section 1031 is a deferral statute. On its face, Section 1031 is not a tax-free exchange. And what this means is if I do a 1031 exchange and I do a sequence of them over many years, and I ultimately sell that last property, all of those taxes that I hadn't yet previously paid come home to roost. The strategy becomes a tax-free strategy only if the investor dies while holding the last piece of real estate. And at that point in time, all of those, or whatever the asset is that that investor owned at the last point in time, will transfer to the heirs, and the heirs will inherit the property at the fair market value as of the date of the investor's death, theoretically getting a step up in basis. And what's nice for them at that point in time is that they can either keep the property and continue to use it as an investment property, or they can sell it. And if they sell it in relatively short order, again, there will be no capital gains tax because if grandpa died in June and they're selling it in October, there's not really any gain between June and October kind of a thing. So that's something important to keep in mind.
Can
All
they
right.
defer? Can the new inherit the can the people that inherited the kids or whoever inherited, can they continue to defer that as a 1031 exchange as well?
Great question. So if they sell it in relatively short order, there's no reason to structure it as a 1031 exchange because they didn't have any gain. Again, if grandpa died in February, March, April, and we're selling September, October, November, realistically, how much gain was there? But if they held on to it for a period of time, a year or two or three, then yes, they can go ahead and do more 1031 exchanges, assuming that they treated it, the property as an investment property and not as their personal use property. Great question. All right. So what taxes is our section 1031 helping us to avoid? Well, first and foremost is the federal capital gains tax, and that's either going to be 15% or 20%, depending on the taxpayer's tax bracket. There's also the tax on depreciation recapture. What is depreciation recapture? During the time an investor owns a piece of property, they are depreciating the improvements made to the property. So that you don't depreciate the dirt, but you do depreciate the structure or the structures. And upon sale, you would have to tally up all of the depreciation you've taken over the years and pay back 25% of that under depreciation recapture tax. There are also state level income taxes. 43 of the 50 states charge a state level income tax. They range from around 3% all the way up to 13.3% for property in California. And Section 1031 applies there as well. Finally, Section 1031 would help with the net investment income tax, sometimes called the Medicare surtax or the Obamacare tax, and that's 3.8% levied against net investment income in any one year. All of these together combine, and I've typically seen a blended tax rate for investors that ranges anywhere from 25 to almost 40%, depending on the size of the asset, how long they've held it, and what tax bracket they're in. When I'm chatting with an investor, I typically assume that we're going to lose 30% of the profits to taxes if we do not structure a 1031 exchange. And I preface that by saying double check with your CPA, who can give you a finite answer, a more definitive answer. But for the purpose of the conversation, 30% is a good estimate. All right. Now, what is the process of a 1031 exchange? Well, the ideal process is that the taxpayer contacts the facilitator as early as possible. And it's never too early to contact us collectively to discuss 1031 exchange. If they want to speak to us before the property is listed for sale, that is absolutely fine. But it's imperative that they contact us before they get to the closing table. So the ideal time to get the 1031 exchange process in gear is when they have an executed contract. Shortly after that, they're going to start scheduling closing, and that window between executed contract and scheduling closing is really the ideal window so that we can get everybody on the same page. At the closing table, everything looks pretty much the same except for a couple of relatively innocuous but very important changes. There is going to be an assignment of the investor's rights in the sale contract and a notice of assignment to the buyer. And that assignment is what allows the closing agent to send the proceeds to the 1031 exchange rather than giving a check directly to the seller. That is critical. The seller, the investor, cannot have even constructive receipt of the cash. Forget about actual receipt. So sending the funds to the 1031 exchange is a very, very important. In fact, it is critical to the success of a 1031 exchange. Now,
Can I
there are,
ask a question in there real
oh, of
quick?
course,
Based on this slide right here, it looks like from zero closing, Dave. So the actual close of escrow of the previous investment property, that starts, it looks like a 45-day process. That's to find a replacement property.
correct. So the close of escrow starts two stopwatches.
Gotcha.
One is for 45 days. That's the identification period. And one is for 180 days. That's the acquisition period. So within 45 days after the close of escrow, the investor must submit a list of potential replacement properties. We're going to discuss that list on the next slide. And within 180 days of the close of escrow, they must actually acquire something from that list.
Gotcha.
Now, we're recording this video on October 21st. So the statute really says 180 days or the due date of your tax return for the year in which the exchange commenced. October 18th was 180 days before tax return day. So we're already shorting this investor by 3 days.
Hey, that's great information to have right there. You want to make sure before October 18th every year you start the process. Like there's a certain necessity to do a little planning on the front end of this process, isn't there?
Correct. So after October 18th, and that date swings one day or the other based on leap year status, right?
Right.
So, and then sometimes the IRS moves tax day because it falls on a Sunday or whatever. But by the time I've always historically started warning taxpayers on October 15th, it's safe. Once we get into November, they're already losing 2 weeks out of their 180 days.
Yeah.
But they can get those 2 weeks back by filing for an extension on their income tax return deadline. You can't file for an extension on your 1031 exchange, but you can file for an extension on your income taxes. So that would get you your full 180 days.
Interesting.
Now, I also mentioned that they have the 180 days or the due date of the tax return to acquire something from that list. Over the years, I've heard taxpayers say, well, I identified property A, B, and C, but I really want to buy D. It wasn't on the list. We can't release the money. 99% of the 1031 exchange regulations apply to the taxpayer, and a very small portion apply to the 1031 exchange company, and that 1% is that we have to restrict the taxpayer's ability to receive even the benefit of the cash. So if they identify property A, B, and C, and then on day 80 say, hey, I want to buy property D, we can't release the money, no matter how much they beg, no matter how much they yell, no matter how much they threaten litigation, we can't release the money. And it's not because we don't want to, and it's not because we're being mean, it's because the regulations say so. And the downside to the 1031 exchange company to releasing the money early is if that particular, excuse me, if that particular taxpayer gets audited and now the IRS sees, oh, look at that. David released the money on day 150 to a property that wasn't designated. Let's go back and audit all of David's files for that year. Now, I'm pretty confident that my files are otherwise neat and tidy and compliant. But what if something that the taxpayer did wasn't? So we've opened up a whole can of worms that we just don't want to expose ourselves or our other clients to. We will comply with the regulation. So again, 45 days to identify, 180 days or the due date of your tax return to acquire something from that list. The proceeds came to us at the close of escrow on the relinquished property. We will deliver the proceeds to escrow for the purchase of the replacement property. We tend to send the money the day before escrow is scheduled to close. Sometimes we'll send it that morning if we're going to be closing escrow later in the day, but the vast majority of the time we send the money to escrow the day before because we don't want to be the cause for any delays or any hiccups. Let the mortgage payoff or the utility company be the cause of the hiccup, but not us, right? It's a customer service issue. Okay. Questions so far?
On the title end of it, an agent going into a listing, knowing it's going to be a 1031 exchange, typically vesting wise, do you typically see it in an LLC or a trust, or is it pretty much it can be husband and wife as joint tenants?
It's all over the board,
Right.
right? It's often just, sometimes it's just one spouse.
Okay.
Sometimes it's both spouses. Sometimes it's an entity or a trust or a corporation.
Right.
And those are all important. But one of the things that we have to pay attention to, not only what does it say on the title report, but how are they actually treating it for tax purposes? Put aside the issue of whether they're in a community property state. I'm sitting in New Jersey, a non-community property state, which means if the property is owned by myself and my spouse, then we must buy the property the same way. If the property is owned in an LLC of which my spouse and I are the two members, that LLC is the taxpayer. However, we've seen with some regularity the accountant disregarding the fact that the law says that partnership is that LLC is a partnership and still reflecting the ownership of that asset on our spousal personal income tax return. Technically, right, from a federal tax standpoint, it's wrong, but we follow the tax return more than we follow the title report.
Right. So going into a listing, if an agent is going into a listing, knowing it is a 1031 exchange, in my opinion, and tell me if I'm wrong, it's always good to do a deep dive and get a property profile so that we know exactly how it's vested and how to kind of tackle it in order to have a smooth transaction, correct?
I agree 100%. Asking one more question is almost always a good idea.
Right. Okay.
Excellent. Yes, thank you, Rose. That's a wonderful point. Yeah, asking that additional question or those follow-up questions, playing junior detective, usually very helpful. Right?
Right.
Because sometimes we find out that title is vested in Tom and Jane, But Jane says, oh, but my father owns 10%. Well, not on the title report, right?
Right, right,
Or sometimes it's the opposite. Tom and Jane own 90% on the title report. Grandpa owns 10% on the title report, but Grandpa has never declared any of the tax ramifications on his income tax return. So there, because all of the income tax benefits and burdens have shown up on their spousal report, we don't do a 1031 exchange for Grandpa. They have to deal with Grandpa some other way.
right, right. So going into a listing, it's always wise to do a deeper dive before you do get to that listing, just so you know what
100%.
questions to ask, whether LLC or how it's vested. And that's where title is helpful, and just doing the due diligence
Yep,
of going into that before signing the listing agreement.
absolutely. And if the investor is uncertain, suggest to them that they look at Schedule E of their income tax return. That's
Okay.
where we find all of the critical information.
Okay, great information. Thank you.
Thank you. Okay, so I told you we would talk about what the identification rules mean. Well, the identification has to be in writing and signed by the taxpayer. Now, in writing, signed by the taxpayer, delivered to the 1031 exchange, but there's a limit on what they can identify. So there are 3 separate rules here. They must only comply with one of these 3 rules. Rule number 1 says identify up to 3 properties, no further questions asked. And this rule is where probably 95% or more of our taxpayers put themselves. They're sold one, they're going to buy one, they know exactly which one it is, no big deal. But they can identify an alternative property as a backup, and they can also identify as a backup a Delaware statutory trust, but that's a little deep for today's conversation. They can identify 1 or 2 or 3 properties, no further questions. Sometimes, however, taxpayers say, no, I need to identify more than 3 properties, and that's okay. So now we're going to disregard the first rule and look at the second rule. And the second rule says that the taxpayer can identify any number of properties greater than 3, so long as the total value of all of those properties does not exceed 200% of the value of the relinquished property. So the taxpayer sold a $100,000 property. They've identified 4 replacement properties. The total value of those 4 properties should not exceed $200,000. It's really relatively simple. Now, sometimes a taxpayer, either on purpose or on accident, violates both of those first 2 rules. So if we have identified more than 3 properties and the total value of those 3 properties exceeds 200% of what we sold, then we must actually close on 95% of the identified value. Wow. So what that means is if I sold a property for $100,000 and I identified 4 or more properties that aggregate to $1 million, I have to close on $950,000 of what I identified. And it's the value as of the date of identification. So here's where the problem is with these second 2 rules. The taxpayer is going to identify in October 2024, and they're not going to get audited until 2026 or 2027. How can they prove the value of the property 2 or 3 years ago? And one of the things that we suggest is that when they identify, they take a screenshot of the listing from the real estate broker's webpage. Right? So 123 Main Street, Ottumwa, Iowa. You take a screenshot, you save the PDF in your file, and you keep it with your other important paperwork for that real estate transaction. If the IRS comes back to you in a year or 2 and says, wait a minute, validate these numbers for me, you have a dated record, right? You take a screenshot today, it's going to show October 21st, 2024. That's That's pretty strong evidence.
So some of the tools that the sales reps at WFG National Title have at their fingertips are tools that create a property profile. And some of those property profile tools include an estimated value built into those tools. Would that be a component that when a sales rep is working with a realtor on delivering content to a client, that property profile report's usually something that is delivered to a buying client that would hold some value then, including that property profile with that estimated value on there, correct?
I would think that property profile report. I don't like the Zillow reports. I know people who say using those. I've found them to be grossly inaccurate. But either your property profile report or whatever the broker, the listing agent puts up on the web page, right? If Mike is listing his property for sale with ABC Real Estate, they've gone out and done their due diligence, probably also looking at your property profile, and the number that they listed the property is probably pretty accurate, right? Might it go down a couple of dollars because there's a repair that Mike didn't remember he had it to get done, whatever. Might it go up because there was a bidding war? That's fine. It's what the value was as of the date of identification. And truth be told, if your property profile report said it's $500,000 and we only had to pay 450 or we had to pay 650, doesn't matter. We bought that whole asset.
Got it.
So in reality, when you're looking at these three rules, like the 200% rule almost negates someone going and listing 10 properties.
Absolutely.
Because it's already going to bump you back into like you should have just picked 3. You've already hit your 200% almost.
So if I had gone back, Eric, and audited all of the 1031 exchanges I've done over the last 25 years, I'm going to bet that somewhere between 95 and 97% used the 3 property rule.
Yeah.
And 99% of what's left used the 200% rule. And as to the 95% rule, that little tiny fraction that's left over, all but 1 or 2 have bought everything. Right. Almost everybody has bought everything. Marita and I had a transaction a few years ago where the taxpayer sold an industrial building. Actually, he sold a 50% TIC interest in an industrial building down in Virginia. And he identified like 18 condo units in the Boston metro. And I saw 18 properties there and I panicked because we're certainly well past the 3 property rule. And I'm running numbers in my head saying that we're probably blowing past the 200% rule. And I called the attorney. He said, don't worry about it. They're already under contract. They're already through due diligence. He's buying all of them. Now, the converse of that is Marita and I had another transaction. I guess it's 2 years ago now. This was one of those you can lead a horse to water, but you can't make it drink kind of clients. And this guy gave us an Excel spreadsheet. I don't remember if it was 25 or 35 lines long. And we had been on the phone with him daily for 2 weeks. And he sends us this 35-line Excel spreadsheet. And in the end, he ended up buying nothing. His exchange completely failed, but it wouldn't have mattered because there was no way he was buying 95% of what was on that list. He couldn't. It just couldn't happen. So we try very hard to ensure that our taxpayers understand the rules, but some people can't tell you how many sides are on one die. So
and you don't do that on day 44 and a half with 2 hours
no, please don't do that on 4 o'clock in the afternoon on day 45.
So you just said something interesting there. You said so his 1031 exchange failed. Yes. I'm assuming you're going to get to that later, and so I don't want to spoil that portion. But my question was kind of like, so what happens when the 1031 exchange fails? Then are you going to cover that at a later portion here?
I wasn't, but I'll cover it now.
Okay.
So for this particular taxpayer, because he backed himself into the 95% rule without listening to all of the guidance that Marita and I tried very hard to explain in plain, simple English. He ended up buying nothing. And even if he had complied with the 3-property rule, he ended up buying nothing. And when you end up buying nothing, you haven't reinvested anything. Your 1031 exchange has failed. And there's really no penalty for a failed 1031 exchange. Remember, I said that your exchange needs to be completed within 180 days or the due date of your tax return. You didn't complete the 1031 exchange, you report the sale of the property on your tax return, you pay the taxes. The only penalty is that you paid the qualified intermediary fee. The capital gains tax wasn't paid late, so there's no interest. And you just don't get to defer the taxes like you thought you were.
Okay.
That's what happens.
Great answer, and that's probably what I figured was happening, but so you just pay the taxes.
That's it.
That's it.
Yep.
Okay.
Yeah, and truthfully, Eric, sometimes it's in a taxpayer's best interest not to do a 1031 exchange. You know, think about it. If the average exchange fee is going to be $1,000 or $1,500, and their total tax liability is only going to be $3,000 or $4,000 or $5,000, they may choose to pay the taxes and start with fresh basis in the next property. So we always encourage taxpayers to review their strategy with their tax advisors, because we are not that person.
Right.
Great
Right.
point. Great point.
None of us wants to assume responsibility for something not covered by our professional licenses.
Right.
That's the attorney in me coming out. All right, next slide. So, and this is the last of the slides that I had prepared, but we can talk for as long as you want. If a taxpayer, if you want to have all of 1031 exchange knowledge on one convenient piece of paper, this is it. Right? This covers the majority of what we would need to have, especially going into an initial consultation. In order to fully defer the capital gains taxes and the other taxes that we talked about, the taxpayer should receive only like-kind property. We didn't discuss like-kind property. Like-kind means business or investment real estate. If I sold business or investment real estate, I need to buy more business or investment real estate. It does not mean that if I sold a condo, I need to buy a condo, or I sold a duplex and I need to buy a duplex. Real estate is real estate is real estate. They need to ensure that they comply with the 45-day identification rule and the 180-day acquisition rule. Our staff sends out lots and lots of reminders. So if a taxpayer misses those deadlines, it's not because we failed. They should also ensure that they trade equal or up in total value. Some taxpayers are of the mind that they only need to reinvest the gain, and that's not what the statute says. They need to trade equal or up in value. And when I speak to most taxpayers, I suggest to them that they look contract price to contract price. Right? So if I sold $500,000, I want to buy at least $500,000. They also want to roll all of the equity, all of the cash into that new property. And here's where the problem comes in. I've seen taxpayers sell property number one with a very low debt to equity ratio. And they want to change that debt to equity ratio. So they sell a $500,000 property and they pay off a $100,000 note. And they go to buy a $600,000 property and they want to get 50% financing. Well, 50% financing means that they would need to have $300,000 in debt, so they would only need $300,000 in cash. The problem is they had $400,000 in cash from the sale. And that $100,000 that they did not reinvest in cash becomes a taxable event. Even though they bought a property of greater value, they ended up with cash in their hand. That is not like kind to real estate. There's where the like kind comes into play. They have cash left over in their hand. You can
Mhm.
replace debt with cash, but you can't replace cash with debt. So when we find out early enough that a taxpayer is planning to do what I just described, we suggest to them that they go back to the lender, have them recast the loan to numbers that will help them comply with their 1031 exchange.
Right. So a seller wanting to go into a 1031 exchange, it is beneficial that they do contact the 1031 exchange facility to give them all of these rules and regulations ahead of time before
we
going into the listing. So they
absolutely,
clearly understand what they're getting into, the time periods, and the due diligence that they have to do as the seller.
absolutely, Rose. We absolutely encourage people to contact us early and often,
Right.
right? I tell people all the time, I would much rather answer 1,000 questions. I would much rather answer the same question 5 times than to find
Right.
out that they didn't ask a very important question.
Right. So as a real estate agent going into the listing, is it best for the real estate agent to give that information to the 1031 information to the seller, as well as do a deep dive title wise to see how everything's vested, and let them reach out to you versus the real estate agent actually giving them all this information, which is a lot.
Yeah, when I have the opportunity to teach a room full of real estate agents, and I've been in rooms with 500 real estate agents, I tell them point blank, do not hold yourself out as the 1031 exchange expert.
Right.
There's a difference between being experienced in 1031 exchange, being fluent in 1031 exchange, and being the expert.
Right, right. There
Right?
seems to be a lot of moving pieces in this
Yes.
1031 exchange, and you definitely don't want to give wrong information because that could be
Absolutely.
a real problem. Yeah.
I used to work with one particular real estate agent. I happened to be with her one day. We were going to an event, and she met a potential buyer at a home just to do a quick view from the curb to see if they wanted to go in, get a viewing. And the real estate agent said to the buyer, "Oh, it looks like you're going to need a new roof if you buy this house." And the lawyer in me almost vomited, thinking, "Oh my God, since when did you become a roofer?" If I was the real estate agent, I would never opine like that. You know, consult other professionals, have a home inspection, have this inspection. Let's get the 1031 exchange company on the phone.
Right.
Absolutely. There's a difference between being fluent and being an expert. And
Right. So you basically want all that information on letterhead in with a professional versus coming from an agent. And same with our property profiles coming from WFG National Title,
correct.
and it's legit. So it's
Yeah.
real. Yeah.
I mean, we can utilize our tools in this, right? The flash farms, the fetch, even our own customer service. But at the end of the day, I feel more comfortable than contacting, David and leaning
Yeah.
on you guys as far as that goes. Because I mean, obviously, you guys are experts at the 1031.
Right.
Well, and this is where I think the symbiosis comes up, right? If your title salesperson is speaking to a real estate salesperson who says, "I have questions," let's do a conference call.
Okay.
Your title person wants to set up a seminar or a webinar for a room full of, ABC Realty agents. Let's do it. Let's share all of that information, and then again, encourage them to contact 1031 exchange early and often.
Right, the seller, so that, because at the end of the day, the seller is gonna be the one that's gonna be responsible for,
Yep.
the taxes and the exchange, and so they have to
Absolutely.
clearly understand what they're getting into.
Correct.
Yeah.
So for
that-
WFG, we have Cynthia Davidson that is gonna be submitting exchanges. So it's good to funnel through her if there are any questions, and then she can, or you guys can reach out to us at the experts box and answer questions. Because we don't want the seller just coming straight to us. We want a WFG member to be with them.
Okay, so that begs a question then. If we go to the website, WFG1031.com, is that like the starting point? Is that the realtor or is that the investor starting that process there? And that's like you said start early, like do your planning on the front end. That's the point of entrance to really let's start having a conversation, correct?
Right.
Yeah,
Mhm.
and whether it's the real estate agent or the investor doesn't really change the conversation.
Okay.
They're going to engage with your team's going to engage with ours, right?
Okay.
Your website should be a fishing net on the back of a trawler. Let's catch what we want. Let's
Right.
catch what we can. We'll filter out what doesn't qualify.
Well,
Right.
and it's a handshake proposition. Like what's happening now is realtors are engaging and interacting with the title sales representatives and escrow representatives. If there's questions in there, that's where that's happening right now that I'm seeing is that the reps are actually pointing the realtor, go there, send your client there, you go there, you start that process on that site.
And here's the value proposition as I see your peers using it, right? I'm a real estate agent at ABC Realty. I call up Mike. Hey, Mike, I need title on this property. And oh, by the way, my client wants to do a 1031 exchange. Who do I call? Now it's just you, right? One call does it all. That's somebody's slogan. I don't know who it is, but one call does it all. So I'm very clearly disclaiming that it's not mine and I can't use it publicly. Um, but yeah, now they only have to call your team member, your office, and I know you have more than just one person out there selling. They contact that person, they work through your internal channel to get it over to our internal channel. Everything's handled in one place.
Right.
And also, if you don't get that title work, you can still do the 1031 portion,
Agreed.
which then on the purchase or in another transaction can get you the title work. So it can work backwards also.
Exactly.
Yeah.
Well, and it's also, I also recognize that on the sales side, you're not generally selling title on the sales side, right? It's my understanding that most states, the buyer buys title insurance. So if the agent is helping sell this property, that's not necessarily a sale here for title, but if they're going to be doing a 1031 exchange, now they're, we've kind of got their hooks in them for their replacement property. Oh, look, WFG handled your 1031 exchange really well. We're going to use them again for title. Golden.
Well,
Right.
I think that's the big push right now is the customer experience. That's certainly WFG National Titles direction and push, and that's the stuff that My Home helps them with. Is it's all about the customer experience, and so anything that you can do as an added value in that process or that communication, it's just icing on the cake.
So let me give you one other tidbit. It's not in the slide. I didn't contemplate talking about it today, but I think it's something worth knowing.
Yeah.
And it came up because I just said that, the buyer is buying title insurance. If we have an investor who needs to buy their new property before they sell their old property, that can still be a 1031 exchange.
Yeah, good.
Right? That's a reverse exchange. Technically, it's called a parking exchange, but on the street, everybody calls it a reverse exchange. It costs a little more money. It takes a little more time to set up. It's got a couple more moving parts, but your team should not be afraid of the fact that, oh my God, this guy needs to buy before he sells. Just one more reason to get Marita on the phone, schedule a conference call.
Right.
We'll educate your team member, we'll educate the taxpayer, and we'll get through it all together as a nice, big, happy family.
Right.
Right. That's great.
That's awesome.
Yeah.
And please send emails to experts@exchange-manager.com. That's the inbox that David and I have together. So whether it's a forward, a reverse, any questions that you need, please let us know.
Will
Awesome.
do.
Well, thank you guys so much. Anything else that you guys want to talk about?
A lot of great information there.
Yeah. Yeah, definitely a ton. So, okay, well, that's perfect. Well,